Hi there, welcome to module 11. So gradually we are drawing nearer. We are left with 2 modules. Apart from those, we are left with 12 and 13, and then we are finished with corporate strategy, ethics and governance. How exciting it has been. So corporate governance framework. This is also a key aspect. We've already started discussing about corporate governance since we started with business ethics. We spoke about governance there, corporate social responsibility. We spoke about issues about governance also there. Then now we want to really look at governance framework here. So after going through this module, you should be able to explain the concept of corporate governance. You should be able to explain the various elements of corporate governance. You should be able to also discuss issues about the symptoms of poor corporate governance. So if there is a poor corporate governance being practiced by an organization, what is the symptoms of that? You should be able to do that. Then third or fourth, you should be able to state the development or explain the development of corporate governance. That is how the issue about corporate governance has been developed over the years. The issue about corporate governance, how it has developed over the years. Then the next one is that you have to explain, be able to explain the Organization for Economic Co-orporation and Development. That is the OED principle of governance in that order. So let's begin with the journey. What really is governance? Governance or corporate governance is simply the system of rules, practices, and processes by which a company is directed and controlled. In other words, the way a company is directed and controlled is what refers to as what? Corporate governance. Now, corporate governance is essentially involves balancing the interests of the company's many stakeholders, such as balancing the interests is with what? The many stakeholders of the company, such as the shareholders, such as the employees, such as the management, such as the, how do we call it, the community as a whole. All these guys come together to form what we refer to as what? Corporate governance. So when we talk about corporate governance, we are talking about the various rules and principles, systems that are used to direct and control an organization. However, corporate governance also involves balancing the interests of all the stakeholders within the organization. And remember the corporate governance concept we spoke about, fairness, treating all stakeholders equally, because it is part of corporate governance, and that is what will mean that the company is acting ethically in an organization. Now, so when we look at corporate governance, there are various elements of corporate governance. So let's look at some elements of corporate governance. The first one is called risk management. A need for a new look about the organization. So board of directors are increasingly willing to take firm managerial action to mitigate the downside risks of strategic change. So in February 2005, for instance, the directors of Hewlett-Packard, that is HP, suddenly resolved or removed Carl Florentina as CEO because of her management of risks and slow progress of the complex of HP Compact measure. So risk management has become a very key aspect of governance. So as a system of how management organization is directed and controlled, board is ready to make decisions to find out how they can mitigate or reduce risks. So with the example that we have here in the year 2005, Hewlett-Packard removed their CEO, that is Khalil Fiorina. Let me mention that word. Fiorina as the CEO of the company, because his style of management of the risks of the company was not liked by the board, was not liked by the shareholders. So she has to be removed in that order. Second element of corporate governance is about efficiency and effectiveness. So good governance means that the processes implemented by the organization to produce favorable results to meet the needs of what? Stakeholders, while making the best use of what? Resources, okay? So our system that we are using, corporate governance, also means that the system implemented are producing or giving or operating effectively and efficiently in the organization, so that the organization is able to use the resources that is exposed to, so that it can meet the needs of all the stakeholders' objective. Next is accountability. Accountability is the key tenet of corporate good governance. Who is accountable for what should be documented in policy statements? In general, the organization is accountable to those who will be affected by its decision or action, as well as the applicable rules of law. So accountability is also very important. So to be able to look at how an organization is directed and controlled, we would have to discuss or look at closely issues about accountability. That is how accountable the organization has to be in that order. Then equity and inclusiveness. This is where the organization must provide equal opportunity to all stakeholders, must treat all stakeholders fairly. Then issues about transparency, I've already spoken about that in that order. Then symptoms of poor corporate governance. What are the things that when they are present will show, or what are some of the events that when they are occurring in an organization will tell that this organization has poor corporate governance in place? One, domination by a single individual. When an individual is dominating the organization, that is a single individual doubling as the CEO and as the board chairman of the organization, then there is a likelihood that there is a symptoms of poor governance. Because for good corporate governance, the role of the CEO and the role of the board chairman has to be separated. That means that two different individuals should handle these roles. But if one individual is playing these two roles, he's the CEO of the company and he's the board chairman of the company, he's likely to dominate upon all decisions, upon all board meetings, and upon all strategies of the company. So that could result, or that could show or make an indication that the company has a poor corporate governance. Then lack of involvement of the board. Boards that meet irregular or fail to consider systematically the organization's activity and the risks are clearly weak. So if the board is not really involved, so there is a board, there are board of directors though, but because of the first problem, single individual domination, the individual is the CEO and is the board chairman, so he doesn't really take or involve the board in the making of decisions, in the making of policies. It could suggest that there is a poor governance in place. Lack of adequacy or adequate control functions. Another potential weakness is a lack of adequate technical knowledge in key roles. For example, in the audit committee on senior compliance position, a rapid turnover of staff involved in accounting or control may suggest inadequate resources and will make control more difficult because of lack of continuity. So if there are not much internal control systems in place as to how things are done within the organization, as to various accounting systems and procedure, the role of the audit committee in the organization, if these things are not adequately available and are not functioning the way they are supposed to function, then it could signify that the organization is what? Having problem with what? Governance in the running of the organization. Then the next one is lack of supervision. This is where employees who are not properly supervised can create large losses for the organization through their own incompetences. So if in the organization there is lack of supervision, people can do everything that they want within the organization. There is no system in place about reporting, about performance measurement, about employees appraisal, then that could lead to poor corporate governance in that order. The lack of independent scrutiny. This means that where there is no independent body like external auditors coming to audit the financial statement of the organization, then that could signify that there is not a good corporate governance practice in place. Lack of contact with what? Shareholders. So if board of directors, management don't have really good relationship with the shareholders, that could also make an indication that there is a poor corporate governance in place, because of the fact that they will be concealing information from the shareholders. They will not inform the shareholders about the rights or the various things that are happening in the organization. And then also emphasis on short-term profitability. If the organization or board of directors are putting in place policies that is only interested in finding out the short-term profitability of the organization and not really looking at the long-term profitability of the organization, that could also show or tell that the organization is having what? A poor governance in place. Then the final one is misleading accounts or information, where the organization is providing its shareholders with misleading figures, misleading financial statements, and when the company is not doing well, they are purporting to show that the company is doing well in that order. That could also lead to what we mean by poor corporate governance. So these are some of the symptoms of poor corporate governance. The next thing we want to look at is corporate governance theories. Now, the debate about the place of governance in an organization can be discussed in relation to or associated with ownership and management of the organization, and we can discuss that using 4 theories. So as to whether governance should be in the organization, and then the role that governance plays within the organization can really be emphasized on by looking at these 4 theories. The first one is the stewardship theory. Now, the stewardship theory states that management is the stewards of the assets of the organization, and good governance requires active participation from all members. So management will act primarily as stewards of the organization. So what a stewardship theory means is that the shareholders of the company have entrusted the business to the management of the company. In other words, management are stewards. They must take care of the business in the best interest of what? The shareholders. And that leads us to the second one called stakeholder theory. This means that management has a duty of care to the organization, its owners, and to its wider stakeholders. So, in other words, management is not responsible only or not to take care of only the resources, but also management has a duty of care to all the stakeholders of the company, first to the organization, second to the shareholders, and then third to other stakeholders of the company. Then the next thing is the agency theory, which is just like the stewardship theory, which means that shareholders employ management as what? Stewards of the company. As such, there is what we call an agency relationship. So shareholders are the principals, and then the management are seen as the agents, and they must act in the best interest of the shareholders of the company. In other words, if they must not take any decision that will harm the shareholders, they must not take any decision that will result in the loss of the funds of the shareholders, in that order. And then the final theory there is called the transaction cost theory. This theory means the way the organization is organized and governs determines its control over its transaction, which is to say that management will be opportunists, or management will be opportunists if they don't undertake decisions that will affect or that would improve upon the maximization of the wealth of the shareholders. So the transaction cost theory simply means that we want to look at the benefit that the management gets rather than the benefit that the employees get in that place. So to bring that line together, that is why we say that there has to be a system in place so that management will effectively pursue only the best interests of the organization and not interests or things that will benefit them in that order. Then the next slide is about stakeholders. We've spoken about stakeholders enough, and I wouldn't spend any time on stakeholders any longer because we've spent enough time on them. But corporate governance, it's about ensuring that companies are run well in the interest of their shareholders, and the wider community. So the need to improve corporate governance came to prominence in the UK in the 1980s, following the high-profile collapse of a number of large companies such as Maxwell, Polypex, PCI, etc. So we want to look at the development of corporate governance. Okay, so the issue about the need to improve corporate governance started in the UK around the 90s when some big companies began to collapse in that order. The second thing also is about poor standards of corporate governance had led to insufficient control being in place to prevent wrongdoing in the US in the 1990s. So in the 1990s, there were a lot of collapse of companies in the US like Enron and then like WorldCom, about scandals. The business has been operating, and everybody knows that these businesses are high-profile businesses, but we end up realizing that the auditors of the organization were having shares in the company and they were protecting the management of the company, and there were a lot of things coming up because there was not strict policies in place in that order. Because of that, the authorities internationally have now been working together for many years to tighten up the standards when it comes to corporate governance. So good corporate governance is particularly important for publicly traded companies because large amounts of money are invested in them, either by small shareholders or from pension scheme and other financial institutions. So because good corporate governance is much particularly important to publicly listed companies or publicly traded companies, that is companies who are listed on the stock exchange. So a well-published scandal mentioned above are examples. So some of the scandals that I've mentioned about Enron, about WorldCom, about Maxwell Company, the collapse of them are some of the things that we have believed that it has abused, management have abused the trust that is what placed on them by shareholders to manage the business in their best interest. So these are how corporate governance has developed. In the UK in the 80s, the collapse of businesses. In the US, the scandals of businesses. So because of that, now corporate governance standards are very, very important, and there are rules and regulations that must be followed in that order. But to be specific, the need for regulations on how companies are run in a good corporate governance manner came to implementation in the year 1991 in the UK. During the 90s, so I'm going to go through the reports with you so we discuss it in that order. So during the 90s in the UK, there were 3 separate committees set up to consider aspects of corporate governance, which each produced a report. So in the 90s, the UK put together 3 different committees to look at different aspects of governance of the organization. So the first one is called the Cadbury Report in the 1992, which focuses on the control functions of the board and of the role of the auditors. Then we came to the Greenberry Report in the 1995, which focuses on the setting and disclosure of directors' remuneration. Then the Hampel Report in the 1998, which brought together the previous recommendation and submitted a proposed code to the stock exchange so that listed companies will look at it in that order. Then the Financial Reporting Council in June 2010, not long ago, revised and renamed the code as the UK Corporate Governance Code, which applies to all quoted quantity and every entity in that order. So what is this UK Combined Code? So there are 45 provisions that are made in this code. These codes can be categorized into board members. That is how the role of the board chairman and board members should be carried by a separate individual. The identification of senior independent directors must be there. Then the board structure and its function, remuneration of directors, how directors' remuneration has to be designed, conduct of annual general meeting, that is how annual general meetings must be conducted in that order. For instance, announcement of proxy votes at annual general meeting, sending out of notices for annual general meeting at least 20 working days before the meetings are taking place. Then there is also a requirement that companies should consider a reduction in the notice period of directors to 1 year or less, early termination of other arrangements in that order. So all these are what we refer to as the UK Combined Codes that guides how a listed company and all public entities must report on in relation to how the business will be directed and controlled, so that the interests of shareholders, the interests of other stakeholders will be protected in the organization. Now, so the next thing we want to look at is the governance principle. Now, basically, I have listed a couple of the governance principles there. I have about 8 of them, but I'm not going to go through all of them. One is to ensure adherence to and satisfaction of strategic objectives of the organization. 2 is to minimize the risks that the organization is exposed to. Remember the risks we spoke about: financial risks, operational risks, compliance risks. So corporate governance principles are there in order to ensure that this is done. Then to maintain the independence of those or of the organization in that order. So I have a number of the governance principles there, and you can go through them in that order. To conclude on corporate governance framework, we're going to look at the principles of corporate governance by the Economic Co-orporation and Development. That is the Organization for Economic Cooperation and Development. That is the OED principle of governance. Now, this organization put together some principles that organizations must follow in order to ensure that they achieve the corporate governance principle and that the organizations are directed and controlled. And you know all of these already indirectly. The first one is called the right of the shareholders. That is, shareholders should have the right to participate and vote in what? General meetings of company. They should elect and remove the board of directors, and they should be given or provided with relevant information on timely basis so that they can make what? Various decisions in that order. Second is about equitable treatment of all shareholders. So irrespective of the fact that the shareholders are preference shareholders or they are ordinary shareholders, all the shareholders must be treated what? Equally in that order. Then the next one is about the role of stakeholders. That is, organizations have a right or duty of care to major stakeholders, not only to the organization, not only to the owners of the business, but to the employees of the organization, to the customers, to the government, to the entire public. So the organization must look at the role of all stakeholders within the scope of operation of the organization. Then disclosure and transparency. That is, there has to be a timely and accurate disclosure of information and matters regarding what? The company. That is the financial situation of the company, the foreseeable risk factors of the company, that is the issue about going concern status of the company, among others. And then finally, the responsibility of the board. That is, the board is responsible for the strategic guidance of the company and for the effective monitoring of what? The management. So the role of the board has to be very stated, or that has to be stated explicitly so that the organization knows what it is about in that order. Now, so why is the OED principle there? So OED principles are there to assist members and non-members of government in their effort to evaluate and improve their organization. And then two, to provide a guidance and suggestion for the stock exchange, investors and corporation and parties that have a role in the process of developing good corporate governance in that order. So this is what we mean by the framework of good corporate governance. And the OED principle, those 5 things are very important. The rights of the shareholders, treatment of all shareholders equally, the role of other stakeholders, disclosure and transparency, and then the responsibility of the board in ensuring that the organization operates effectively and efficiently in that aspect. So these are what you have to understand when it comes to the framework of good corporate governance. And I'll see you in the next module.